Welcome to the Capital News. I am your host, Alex Correas. Today is June 17th, 2019. Thank you so much for joining me. A few things before we get started today. I just want to wish all the dads out there a belated happy Father's Day. I know I didn't do a podcast last Friday, and so I would have done it then, obviously, beforehand. But I just want to say I hope all you guys enjoyed your day. Hope you were well taken care of. You most definitely deserve it. And obviously, my dad is the best. So happy Father's Day out there. And you're just going to have to wait for next year, I guess, to have another day for yourself. I mean, I know you're going to have to wait 365 days, but it's the kids' day every other day, so you can get one, I guess. Now, today, we're going to talk about what I was hoping to talk about last Friday, but didn't get a chance to do that podcast. And it was in regards to negative yielding debt. We are in the neighborhood of over $10 trillion worth of debt instruments out there, typically government bonds, that are yielding negative rates. So typically, when you give your money to the government, when you lend it, I should say, to the government, you're expecting to get your principal back plus some sort of interest rate, some sort of interest. That's your yield, okay? Negative yields, you're getting less money back than what you gave them. You say, you're scratching, well, why would you do this and that and the other? It makes absolutely no sense whatsoever. This is why I'm telling you guys we are in uncharted territory. This is why I say all the time we have the lunatics at the helm. This is absurd. This is insanity. This is why I say all the time that we are living in the financial world of Oz. There's no doubt about it. $10 trillion of global debt with a negative yield. And it's rising, by the way, because you continue to have negative yields, specifically in Japan and Germany, even Switzerland now, and I think even the Netherlands is starting to have some of their government bonds trading in negative territory as well. Can't make this stuff up. Now, the serious question is that going to make its way here in the United States of America? And that's becoming an interesting question. Because it could. It most definitely could. Now, there's different regimes. There's different mandates between different central banks the world over. Of course, we talk about ours here all the time, the Federal Reserve having a dual mandate of full employment and stable prices. And we talk about how the Federal Reserve, given the government's own statistics, can check off both of those boxes. We're sitting at 49 and 50-year lows on unemployment. 3.6% is the headline figure. We have inflation running below 2%. That's price stability. In fact, the lower the inflation rate, the more stable prices are. Of course, we don't believe both numbers, but those are the government figures. That's what we're being told. So the Federal Reserve should have no reason to have to cut interest rates, and most definitely would not have to implement another round of quantitative easing, which would be QE4. Yet somehow, the president and his administration wants to say that this is the best economy that ever was. Yet somehow, we have to cut interest rates, and we have to implement another round of quantitative easing. That, ladies and gentlemen, is living in the financial world of Oz. Makes absolutely no sense whatsoever. None whatsoever. So I don't care how much you might like President Trump or dislike President Trump. That makes no sense whatsoever. Unless, of course, you've been listening to this podcast and you understand why the president's probably doing it. Because he has taken ownership of this economy and the stock market. And if this thing turns over, if it goes south, he wants to blame somebody. Excuse me. He wants to take credit for all of the good things, all of the quote-unquote good numbers, but any of the negative, this market turning over, it's somebody else's fault. It's those damn Democrats who continue to investigate him. It's these damn endless wars that we can't get out of, and now we're saber-rattling in the Middle East with the Iranians. It's these darn Chinese and this trade war that I just can't seem to solve. It's one thing after the next. It's the Federal Reserve. They don't have a feel for the markets like I do, the president saying that. We should cut interest rates. We should embark on another round of quantitative easing. The very policies, ladies and gentlemen, that have kept this economy down. It's kept this economy down because all it has done is glossed over the problems that we faced a decade ago in the Great Recession. That's all it did. It's kicking the can down the road. This has been a continuous bailout of the major banks and the major corporations. This has been a bailout of Wall Street, not Main Street. And I don't like the class warfare, you know this. But again, when it's done fraudulently, when it's done with this type of fraud and flawed economic policy and fiscal policy, I got a big problem with it. That's what this podcast is about. It's about educating the people on understanding what is taking place. Because how many people do you think know what the Federal Reserve is? Do they even know the Federal Reserve exists? Do they know who the chairman is? Do they know any of the members on the board? Do the American people know what the Federal Reserve does? Could they explain it? Could they connect the dots from point A to Z and beyond? What that means for the country? What that means for society? What it means to their pocketbook? These are serious questions. And most people don't have the answer. They don't know what the Federal Reserve is. They don't know who the chairman is. They don't know who the board members is. They have no idea what the Federal Reserve does. They have no idea if it's independent, if it has to answer to Congress, if it has to answer to the Supreme Court, if it has to answer to the President of the United States. No idea. Who owns them? People don't know. This is the problem. But everybody knows the basketball score. Everybody knows who's in the Super Bowl. Everybody knows what celebrity is dating what celebrity. This is the problem. I would love for everybody to be able to pay attention to all that other stuff. I really would. After the fact that we kick these people to the curb. Because then you don't got to worry about them. And the Fed, and get rid of the federal income tax. You have to do it. If anybody does not address those two things, you cannot take them seriously, in my opinion, because they're not going to solve a damn thing. You have to starve the beast, and that's how you're going to do it. Now, I'm going to be probably talking till I'm blue in the face. If I live a long life until I'm 100, I'm going to be saying the same thing. Federal Reserve's probably still going to exist. Federal income tax is probably still going to exist because nobody wants to wake up and pay attention to what's actually taking place. And that's it. You got to root cause the problem. It's the Federal Reserve, and it's the income tax because they're robbing us blind. Robbing us blind. And there's no end in sight. $23 trillion in debt and counting. Nobody wants to talk about it. Social Security, Medicare, which is causing our bankruptcy, going insolvent within a decade. Nobody wants to talk about it. Why talk about it? And now you got President Trump. Again, candidate Trump he had his eye on the ball. At least I thought. Again, that was the main reason why I voted for the man. Because, damn, I was like, somebody is talking about the Federal Reserve. It's about time. I mean, the only other person that was really ever talking about it was former Congressman Ron Paul of Texas. You had his son, Senator Rand Paul, talking about it, but he wasn't going to beat Trump in the 2016 Republican nomination for president. That wasn't going to happen. But nevertheless, you had Trump making comments. I was like, man, this guy might actually get it. I can put aside some of the ethical and moral questions. I can put aside some of the hyperbole and the exaggerations and the misstatements and this, that, and the other and the controversies. I can put those things aside because he is talking about what I believe to be the root cause, or at least one of them, and it's the Federal Reserve. And here's this guy saying low interest rates was a problem. It's caused a bubble in this economy. It's caused a bubble in the stock market. It's done nothing to benefit the American people at large, but it has benefited the upper echelons of society, such as himself. We've stated other legendary hedge fund managers who have stated the same thing, that it's the largest wealth transfer in the history of mankind. And maybe, just maybe, the president was going to go after him on the low interest rates and quantitative easing. Now he's calling for it. Now he wants more poison. He wants more of the problem. It makes absolutely no sense, but he's dancing because he's taken title of this economy and the stock market. So he wants to be able to blame somebody. And he might get away with it. I don't think it's going to be that easy, But he's going to try. There's no ifs, ands, or buts about it. So we have over $10 trillion in negative yielding debt around the world. This is not good, ladies and gentlemen. It is coming home to roost. You have to understand how the banking sector works. They borrow on the short end, they lend at the long end, and they pocket the spread, the difference. When you're not getting any money back, when you're borrowing short, that's a problem. It's squeezing your margins. That's why the banking system throughout Europe, because that's where predominantly a lot of this negative yielding debt exists, you're seeing a lot of weakness in European financials. We talk about it here all the time. The German banks, Commerzbank, Deutsche Bank, the Italian banks have been in trouble for a long time. UK banks, Spanish banks, French banks, it's all over the place. They're not making money. And then with the massive sell-off that we witnessed in the fourth quarter of 2018, you had a lot of these banks and their trading desks, they completely got caught off guard. And a lot of them lost money at the end of the year. So they're continuing to lick their wounds since the fourth quarter of 2018. And of course, we were discussing our 30 market risks for 2019, particularly early on within this podcast. So starting all the way back in February and March, we were going through it. We add to that list every once in a while. That was a list that was put together by Deutsche Bank. And of course, number 31 that we added that one to the list, was Deutsche Bank itself. That they might collapse. Or that they might take some sort of big hit. And lo and behold, as the months have gone on, what have we seen? We've seen a deterioration in the fundamentals of that company. We've seen the German government trying to merge two of their largest banks, Commerzbank and Deutsche Bank, trying to merge them together. Somehow, the Germans thought two pieces of crappy coal merged together would make a beautiful diamond. I thought the Germans were smarter than that. All it would have been was one big piece of crap. That's all it would have turned out to be. Lo and behold, you have about, 6 weeks of negotiation back and forth between Commerzbank and Deutsche Bank, and they walk away from the negotiating table because there's just too much that needs to be done, and they're not going to get away with it. So those talks are off the table. Not to mention, if there was a merger, you probably would have lost tens of thousands, and I mean that, literally, tens of thousands of jobs lost because of the overlap of these two large banks with the global reach. Now what do we see? Because Deutsche Bank is back in the news. Deutsche Bank is now pondering the possibility of spinning off about $50 billion of bad assets on their books and creating a quote-unquote bad bank. Let's put our junk off. Let's create another entity. Let's spin it off. Let's sell $50 billion worth of this crap onto the market. Now, to me, ladies and gentlemen, and you got to pay attention to this to me is a foreshock. This isn't the earthquake. This is not yet the catalyst, but this is a foreshock. If Deutsche Bank does actually go down, that will be the catalyst. That'll be an earthquake, and that'll be a big earthquake. You're talking 7.0, 8.0. That's a big one. That's a big boy if Deutsche Bank goes down. What this is, $50 billion, spinning it off, trying to create this quote-unquote bad bank, that's a foreshock. That's a forewarning. This is Deutsche Bank. This is the government of Germany trying to get ahead of what's coming. Because I can guarantee you, I can just about all but guarantee you, that it's a lot more than 50 billion. But 50 billion is a number that's big, but it's not too big. You get what I'm saying? They're playing a narrative. They don't want to spook the markets. They don't want to create a panic. But I bet you it's a lot more than that. I wouldn't be surprised if it's twice that, 3 times that, even 4 times that. Maybe even more, to be perfectly honest with you. Would not be surprised because they are so leveraged, it's not even funny. And then you have the CEO of Deutsche Bank saying that he wants to continue downsizing the bank, which means more people are going to be laid off. More people are going to be gone. He wants to, I think, disassemble the U.S. equities trading. So, I mean, that's going to affect some jobs. This guy has been doing this for quite a while with no effect. No effect to the upside because the stock continues to trade lower. It's below $7 a share. If this thing continues lower and stays in the sixes, probably below $6.50 from some of the reports I read by some people who are the analysts on Deutsche Bank, they say look out below, because that's probably going to be it. And again, we've talked about this here on multiple occasions, that Deutsche Bank will be reminiscent of Lehman Brothers collapsing in 2008. That's what it'll be. Again, that's the earthquake. That'll be the shot heard round the world. Because if Deutsche Bank goes, the interconnectedness of how the global, not just the European, but the global financial sector works, it's going to have a ripple effect the world over. So what's going to be the medicine to continue to prop up the markets? How much more liquidity can central banks the world over pump into the system? What good's it going to do? How much fiscal leeway do global governments have? Because is the appetite going to be there, politically speaking, especially when we are in a world of growing nationalism and growing populism? How many people are going to want to bail out the bankers again? Only 10 years later. Not a chance in hell. It's not going to happen. It'll be revolution all over the place. So this is getting very, very interesting. I could be wrong. Maybe people are in such a daze, they're in such a comatose state, that they have so much Xanax and Prozac and everything else that they're on, that maybe they don't know what's going on, and maybe they'll be fine with the government bailing out banks for a second time within a decade. Maybe they'll be completely cool with it. I don't think that's going to be the case, but we're going to have to wait and see. Unfortunately, it's going to happen, meaning that these banks are going to, or they're going to collapse, or they're going to take some big hits. There's just no ifs, ands, or buts about it. You got a global economy that's slowing down. It's just going to happen. You got $10 trillion in negative yielding debt. These chickens are going to come home to roost. And it's not going to be pretty for anybody. For anybody, believe me when I tell you. So that's the negative yielding debt. That's Deutsche Bank. Now to some other things that we obviously talk about on a daily basis. We have the S&P up 3 points. The Dow closed up 23. The NASDAQ gained 48 points, representing about a 0.6% gain for the day. The Russell 2000, the small cap index, gained 10 points, also representing about a 0.6% increase for the day. Dow Jones Transports lost 100 points, representing a decline of about 1 percentage point for the day. And the New York Stock Exchange was about even, losing just about 12 points. Oil, despite the continued tensions transpiring within the Middle East, still no spike up today, because I think they're paying more attention to the global demand picture as opposed to the geopolitical tensions. So we have WTI trading at $51.77, and we have Brent trading at $60.88 a barrel. Gold, still range bound right now, $1,344 an ounce. Silver still below 15, trading at $14.82. The volatility index gained about half a percentage point, sitting at $15.35. So things we're going to have to pay attention to. But another story I want to get to here before we wrap things up. We have the President, Donald Trump, tweeting out, I don't know if this is a threat, if this is just a statement. I don't know how to interpret this one. Basically saying that if he loses the 2020 election, that we will witness a stock market crash, the likes the world has never seen before. So I don't know how to interpret that. I don't know if that's just a statement and he's trying to say, look, the markets love Trump. You put in a lunatic Democrat, you're going to have a problem. Or if he's threatening. I don't know how to interpret it. It's probably the former. I hope he's not threatening. But nevertheless, this is just another piece of evidence that the president is close to being obsessed with the stock market. I mean, I don't know if you guys caught his interview with George Stephanopoulos over the weekend, or caught some tidbits here and there. But him and George were going back at it, which, is par for the course. That's not surprising. But he was saying, George, you got to read Article 2. Article 2, and of course he's talking about the U.S. Constitution. Article 2 talks about the powers that are vested within the president and the executive branch. You got to read Article 2, the powers that he had. And he was talking about the Mueller report. I'm not going to go off on a tangent. Article 2. Excuse me. Well, the president was, Mr. President, where in Article 2 does it say that you're responsible for the stock market, that you're responsible for the economy? Crickets, I know, it's not there. It's not the president's job to own and to manage the economy and or the stock market. It's the job of the people to do that. I mean, that's what this country was founded on, that it's governed by the consent of the people. And you have things that are laid out there within our Constitution, and if it's not explicitly stated within the Constitution, then it belongs to the states and it belongs to the people. Well, this is supposed to be a free market capitalistic system. Far from it. Because that's the other thing that we're facing this week. It's only Monday. And the market's very little moved. Of course, the NASDAQ had a little bit of a gain, and so did the Russell, but I mean, the S&P and the Dow not moved much, which is par for the course during the week of a Fed rate decision. We've had enough of these over the course of the past several months. We know that this is the case. So we have global economies, global markets waiting on pins and needles to see what the Federal Reserve is going to do. And some other central banks, but primarily the Federal Reserve, because we're still the kingpin. What are they going to do? How is this free market capitalism? It's not, is the simple answer. The president said this will never be a socialist country. Unfortunately, it already is. It's too late. We have a Politburo that decides and determines what the cost of capital is going to be. We have 7 billion people waiting on pins and needles to see what 12 idiots that sit around a big table are going to say is the interest rate here in the United States of America. You can't make this stuff up. It's 12 idiots here. It's 12 idiots across the pond at the Bank of England, Bank of Japan, the ECB. I mean, Reserve Bank of Australia just came out their minutes from their meeting earlier this month, where they did cut interest rates, as was anticipated by us here at the Capital News and by markets as well. But now they're hinting at further interest rate cuts. I told you, folks, this is going to be another race to the bottom amongst currencies. That's all it is. Because there's a lot of people out there, there's a lot of analysts out there, a lot of smart people out there saying that there's going to be a dollar crisis. There could be. It is possible. But to me, I think they're missing the boat. I think they're missing a lot of the other weakness that exists the world over. And where is everybody going to run to? Where are they going to go? Australia is obviously deteriorating. There's no surprise here. That was one of our risks. We talk about that here all the time. We're going to see the same thing coming out of Canada. We already have the People's Bank of China putting the pedal to the metal to stimulate their economy because they're slowing down. We know the Japanese love to print money like it's going out of style. That's what they do. Who's going to bail everybody out? Or where is everybody going to go for safety? I mean, your typical currencies when they do this, Japanese yen, Swiss franc, US dollar. People aren't going to be flocking to the euro. Given the banking crisis that is looming in Europe, we just talked about it, Deutsche Bank. That'll be the kickstart. Or maybe it's going to be somebody out of left field. You have nationalism and populism on the rise. Who's going to trust that system to stay intact when it comes down to it? I don't think many people are. How many people are going to trust the Chinese? Communism. How many people are going to trust communism with all their money? Not many. Australia is deteriorating. Canada is deteriorating. Best looking girl at the dance is the United States of America. It doesn't make us a good bet. It just makes us a better one. And we live in a world that is all relative. So for people who think there's going to be a dollar crisis, there probably will be. But I think it's going to be after the unwinding of a whole bunch of other things. Because if you have a dollar crisis, there's really nowhere to go. Because we're still the kingpin. It's still the reserve currency of the world. So many contracts and obligations are tied to the U.S. dollar. I mean, if you have a dollar crisis, ain't nobody safe, is the best way to put it. Ain't nobody safe. So we're going to have to keep updated on this, because if the Federal Reserve does come to the quote-unquote rescue of Wall Street because they want to throw another hissy fit, bad news is good news. Anything bad is good for the stock market, because now that means the Federal Reserve is going to cut interest rates. I think the market better be careful for what it's asking for what it's wishing for. Because if I'm right here and the laws of diminishing marginal returns are really starting to kick in for lower interest rates and quantitative easing, then look out below, because there's not going to be much of anything that could save us. A trade deal ain't going to do it, because that's a cover story. That's a cover story. There's just not enough there to miraculously save the global economy simply because you removed some tariffs on some goods that most people shouldn't be buying as crap anyway. But nevertheless, that's what we do. So stay tuned, because it's going to be very interesting. And really, before I go, one of those bad pieces of information, I don't know how it's bad, because we're told we're in the midst of the best U.S. economy ever. But the New York Empire State Manufacturing Index plummeted 26.4 points from the previous month to a negative 8.6 in June, missing market expectations of a positive 10. We have negative 8.6. They were anticipating positive 10. That was the largest monthly decline on record, due to drops in both new orders and employment, while shipments increased at a slower pace. Now, if the Federal Reserve is looking for cover to cut interest rates this week, they have a few data points. They have that index. They have the poor employment report for May, 75,000 jobs. This is very interesting, ladies and gentlemen. This is my fun. This is my Super Bowl. So buckle up. You got some people who think they're actually going to throw a surprise cut in there this week. I don't know if I'm in that camp. I don't think I am. I think they're going to be in wait and see. I think there's too many data points that says, we got to wait and see what's going on here. It's not like them to be overly preemptive to try to blunt negative shocks. It's really going to call into question their credibility. Who do they work for? What's going on here? We know who they work for. They work for Wall Street. They work for the big banks. But I think that for the purpose of the public, for the purpose of not looking like they're a puppet of President Trump, they're probably going to be wait and see. And that's what we're going to have to do. We're going to have to wait and see, but buckle up, because that announcement's going to be out on Wednesday, 2 p.m. I'll be here, and I'll keep you guys posted. Thank you so much for joining me. It's been a pleasure having you. As always, please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. This is the Capital News. I am Alex Karitis. Godspeed.